The origins of money, from paper to digital. Where does money come from? Every hour around the clock, a government facility in Washington, D.C. transforms paper into money. To meet demand, these machines operate 24/7, generating over $500 million daily for the U.S. economy. Yet, this physical cash represents only a small fraction of the money in circulation. The majority of our money exists digitally, with more than $4 billion added every day. But where does all of this money actually originate? Before it ever reaches your bank account, it changes hands countless times, moving through individuals, businesses, and governments after being created with just a few keystrokes on a computer. We've mapped out the entire process to reveal how money truly works. We'll show how it fuels the economy, drives inflation, and ultimately contributes to debt. But to understand how we arrived at this system, we need to go back to a time before money even existed. The origins of money. Thousands of years ago, if a farmer needed a tool, he would visit a local toolmaker to acquire one. Since he had nothing to trade immediately, they agreed that he would owe the toolmaker something in the future. Because the toolmaker trusted the farmer, this promise of future repayment was considered a valid form of exchange. Sure enough, 2 weeks later, the farmer returned with food from his harvest as payment. To simplify trade, people began using commonly needed items like cattle, grain, and salt as currency. Since these commodities were essential and scarce, they held value. This system allowed the farmer to pay for a tool immediately using a fair portion of grain. It made transactions quicker and more convenient. However, as trade expanded, exchanging bulky goods became inefficient. The transition to metal coins. People eventually transitioned to using metal coins, gold and silver, because they were small, valuable, and didn't perish like grain or livestock. This shift facilitated global trade, allowing goods to be bought and sold across continents from China to Europe. But carrying large amounts of gold was both heavy and risky. This challenge led to a major transformation in how money functioned. In 17th century London, trusted goldsmiths began storing people's gold coins for safekeeping, charging a small fee for their service. In exchange, they provided customers with paper receipts, promise notes, allowing them to retrieve their gold at any time. Crucially, these notes could be redeemed at any goldsmith, making them as valuable as the gold itself. Before long, people started exchanging these paper notes directly in trade, rather than collecting their gold. Goldsmiths soon realized that most depositors never withdrew their gold all at once. The birth of loans. So they began issuing extra promise notes, essentially creating new money, to lend out in exchange for repayment with interest. This was money that didn't physically exist in their gold reserves. For instance, if a goldsmith issued a loan worth 100 coins, they weren't 100 coins poorer. They simply wrote a new promise note worth 100 coins, which could be used as if it were real money. When the borrower repaid the loan with interest, the goldsmith gained extra coins without actually spending any of their own. Furthermore, As the borrower spent their money, others in the economy benefited, growing wealthier in the process. From that single loan, 100 new coins entered circulation, without any new physical coins being minted. As long as everyone didn't demand their gold at once, the system functioned smoothly. This, in essence, is how today's banking system operates. Modern banking and digital money. Swap goldsmiths for modern banks and paper notes for digital currency, and you have the foundation of our monetary system. When 17th century goldsmiths started issuing loans with money they didn't actually have, it had a profound effect on the economy. Previously, the total amount of money in circulation remained constant, merely changing hands in transactions. However, this system had a fundamental limitation. Imagine 4 people sharing a total of $100. If one person pays another for food, the money shifts, redistributing wealth. Then if that person pays a third for a service, the funds move again. Each transaction creates value and fuels productivity, but over time, money becomes unevenly distributed. As a result, fewer people can participate in trade, slowing down the economy. Why more money is created. Since perfect balance in spending is impossible, an economy without new money growth eventually stagnates. By injecting more money into the system, businesses can expand, new products can be developed, and society as a whole can progress. This is why a continuous flow of new money is essential to modern economies. But how is this money actually created? We tend to think of banks as secure places to store money, but that's not their true function. When you deposit money in a bank, the bank owes you that amount. It's a liability for them. The balance in your account isn't a stack of cash sitting in a vault. It's simply a digital record of what the bank owes you. A loan functions in the opposite direction. When a bank lends money, you owe them the amount plus interest. How banks create money out of thin air. Just like the goldsmiths, when banks issue loans, they don't give out existing money. Instead, they simply type new money into your bank account. This newly created money didn't exist before. It's entirely digital. However, once you repay the loan, that money disappears, leaving only the interest behind. This process fuels the economy. For example, if you take out a loan to buy a car, that money is transferred to the dealership. The dealership then uses it to pay employees, who in turn spend it elsewhere. This creates a ripple effect, powering businesses, funding new technologies, and sustaining daily commerce. Without this process, economic growth would slow dramatically. The role of central banks and government bonds. Historically, banks could only lend a fraction of their actual cash reserves. But today, banks have near total freedom to create money. If they need additional funds, they can request more from the central bank. And this is where things get complicated. To generate new money, the government issues bonds, essentially IOUs that guarantee a steady return. Banks, corporations, and foreign nations purchase these bonds, providing cash to the government. This money is then spent on public services, infrastructure, and wages before eventually flowing back into banks. The issue is that the U.S. government consistently spends more than it earns, leading to perpetual debt. To cover this, the government issues even more bonds, creating a cycle of borrowing and repayment funded by taxpayer money. Thanks for watching. Don't forget to like, subscribe, and leave a comment below. I'd love to hear from you.